November 2nd, 2022, New York City. A website called CoinDesk publishes a leaked financial document. It shows the balance sheet of a trading firm named Alameda Research. Billions of dollars in Alameda's assets are not cash. Most of it is FTT, a token invented by Alameda's own sister company. That sister company is FTX, one of the largest cryptocurrency exchanges in the world. Both firms were built by the same man, a 30-year-old named Sam Bankman-Fried. Bankman-Fried grew up in Palo Alto, California, the son of two Stanford law professors. He studied physics at MIT, then took a job trading exchange-traded funds at Jane Street, a Wall Street firm known for its secrecy. He left in 2017 to found Alameda Research, a crypto trading firm, and 2 years later, FTX, an exchange for trading crypto derivatives. Gary Wang, a friend from MIT, co-founded FTX with him and wrote most of the original code. Within a year, the exchange was processing billions of dollars in daily trading volume. He wore rumpled t-shirts and cargo shorts to meetings with billionaires. During one pitch to Sequoia Capital, he reportedly played a video game the entire call. Sequoia invested anyway. He spoke often about effective altruism, a philosophy that says the point of making money is to give most of it away. Investors and journalists called him a genius. Some called him the next Warren Buffett. Within 2 years, FTX moved its headquarters from Hong Kong to the Bahamas. By January 2022, the company was valued at $32 billion. Sequoia, SoftBank, and Temasek, Singapore's state investment fund, all invested. So did dozens of smaller venture firms. FTX bought naming rights to an NBA arena in Miami. Bankman-Fried appeared in a Super Bowl commercial. He flew to Washington and testified before Congress about how crypto exchanges should be regulated. He became one of the largest political donors in the country, giving tens of millions of dollars to campaigns on both sides of the aisle. Behind the exchange sat Alameda Research, a trading firm run by Caroline Ellison, Bankman-Fried's on and off girlfriend. Alameda traded cryptocurrency for profit. What almost nobody outside the two companies knew was that FTX's code carried a hidden flag on Alameda's account. It let Alameda draw on customer deposits without ever tripping the automatic checks placed on every other user's account. Earlier that year, the wider crypto market had already started to crack. In May 2022, a token called Luna collapsed to nearly zero within days, wiping out $40 billion. Two major lenders, Celsius Network and Voyager Digital, followed it into bankruptcy that summer. A trading firm called Three Arrows Capital collapsed too. FTX and Alameda stepped in as a lender of last resort, extending credit lines to some of the wounded firms. Some of that rescue money, prosecutors later said, was customer money that was never supposed to leave FTX at all. According to federal prosecutors, FTX customers deposited billions of dollars to trade on the exchange, believing their funds sat untouched until they chose to withdraw them. Some of that money moved to Alameda instead, which used it to cover trading losses, buy real estate in the Bahamas, fund political donations, and pay for celebrity endorsements. Tom Brady, Gisele Bündchen, Larry David, and Stephen Curry all appeared in FTX advertising. None of them, prosecutors later said, knew where the underlying money came from. FTX marketed itself as the safe, grown-up alternative in a young and chaotic industry. The exchange serious institutions and everyday savers alike could trust. Millions of ordinary users opened accounts, some depositing rent money, retirement savings, and family funds, trusting that FTX simply held it for them, the way a bank might. Alameda, meanwhile, was not just another customer. It also traded against the exchange's own users, a structural conflict Bankman-Fried had always downplayed in public. Then came the CoinDesk report, on the morning of November 2nd. It showed that a large share of Alameda's assets was FTT, a token FTX itself had created and could print at will. 4 days later, on November 6th, the head of a rival exchange made an announcement that would end FTX's existence within a week. Changpeng Zhao, known across the industry as CZ, said Binance would sell its entire stake in FTT, citing what he called recent revelations. The price of the token started to fall. Within hours, FTX customers panicked. They rushed to withdraw their money. 2 days earlier, Bankman-Fried had posted online that FTX and its assets were fine. Over the following 72 hours, withdrawal requests reached an estimated $6 billion. FTX could not pay them. The cash was not there. Much of it had already gone to Alameda. On November 8th, FTX froze customer withdrawals. That same day, Bankman-Fried and CZ announced a deal. Binance would acquire FTX and absorb its liquidity shortfall. Crypto markets briefly steadied. Inside FTX's Bahamas offices, employees learned most of what was happening from Twitter, the same as everyone else. The deal did not survive one day. On November 9th, Binance walked away. In a public statement, the company pointed to FTX's mishandling of customer funds and reports that United States agencies were already investigating the exchange. The price of FTT and of the wider crypto market fell further. The collapse did not stop at FTX's own walls. Genesis Global Capital, a major crypto lender, halted withdrawals within days, citing exposure to FTX. BlockFi, another lender that had leaned on FTX for a rescue loan earlier that year, filed its own bankruptcy weeks later. Bitcoin, which had traded above $20,000 that spring, kept sliding through November. The next day, Bahamian regulators froze the local assets of FTX's Bahamas entity and moved to appoint liquidators of their own, opening a second front alongside the coming bankruptcy in the United States. 2 days after Binance walked away, on November 11th, FTX filed for Chapter 11 bankruptcy in Delaware. So did Alameda Research and more than 130 affiliated companies. Bankman-Fried resigned as CEO that same day. His replacement was John J. Ray III, a lawyer who had spent decades cleaning up corporate collapses, including Enron's. In a court filing, Ray wrote that in over 40 years of legal and restructuring work, he had never seen such a complete failure of corporate controls. Roughly 300 FTX employees found out their jobs had ended not through a memo, but through news coverage. Offices in the Bahamas and around the world went quiet within days. The effective altruism movement Bankman-Fried had championed for years moved quickly to distance itself, returning donations and scrubbing his name from websites. Investigators later estimated that customers alone had lost roughly $8 billion, funneled into Alameda to cover losses that traced back to the same FTT token that had triggered the panic. Equity investors lost close to $2 billion more. Lenders to Alameda lost over $1 billion. More than 1 million people and businesses were listed as creditors in the bankruptcy filing. Bankman-Fried stayed in the Bahamas at first, giving interviews from his apartment in the same tone he had always used: calm, boyish, unbothered. He called it a liquidity crunch, not fraud. In a private message exchange with a journalist days after the collapse, he described his own public talk of ethics as mostly a performance, something regulators and reporters wanted to hear. On December 12th, Bahamian police arrested him at the request of the United States government. Days later, he waived extradition and was flown to New York to face criminal charges. Two of his closest colleagues turned on him: Caroline Ellison, who had run Alameda, and Gary Wang, who had co-founded FTX and written much of its code, pleaded guilty to fraud and agreed to testify against him. A third executive, Nishad Singh, did the same. Each of them faced years in prison. Each hoped cooperation would earn them less. Bankman-Fried was released on bail and sent to his parents' home in Palo Alto, fitted with an ankle monitor. In August 2023, a judge revoked that bail. Prosecutors accused him of leaking Caroline Ellison's private writings to a journalist in an attempt to influence the case. He was jailed in Brooklyn to await trial. The criminal trial opened in a Manhattan federal courthouse in October 2023 and ran for nearly a month. Prosecutors called it one of the largest financial frauds in American history. Ellison, Wang, and Singh all testified against their former boss in detail. Ellison told the jury that Bankman-Fried had directed her to use FTX customer funds to cover Alameda's debts, and that she had known it was wrong at the time. Bankman-Fried took the stand in his own defense, insisting he had never intended to steal from anyone. The judge later said he had never seen a witness so evasive in decades on the bench. On November 2nd, exactly 1 year after the CoinDesk report that started the collapse, a jury convicted Sam Bankman-Fried on all 7 counts, including wire fraud, securities fraud, and conspiracy. In March 2024, Judge Lewis Kaplan sentenced him to 25 years in federal prison, about half of what prosecutors had requested. Kaplan acknowledged Bankman-Fried's obvious intelligence, then said he had heard no genuine remorse from him for the crimes themselves. Kaplan added that there was a real risk Bankman-Fried would be in a position to do something very bad again. Bankman-Fried told the court his useful life was probably over. Away from the courtroom, John Ray's team spent years hunting down what was left. Bankman-Fried had personally bought a 7% stake in the trading app Robinhood using Alameda money, and 3 parties, including the Department of Justice, fought over who owned it. The government won, seizing the shares and selling them back to Robinhood for over $600 million. Ray's team separately sold off real estate, art, and stakes in dozens of startups. By 2025, the estate had begun repaying creditors in stages, promising to return more than each customer was owed, measured in dollars, on the day the exchange collapsed. Critics noted that in crypto terms, many customers were still receiving far less than what their coins would have been worth had they simply been allowed to keep them. For the man who built FTX and broke it, the reckoning was simpler. He was ordered to forfeit $11 billion.